What triggered the financial crisis in the European Union that mainly affected Italy and Spain? This question ushers us into a labyrinth of intertwined economic factors, political stratagems, and societal repercussions. As we begin, let's ensure we're buckled up for this intricate journey through the accounts of financial turmoil. The narrative initiates in the latter part of the 2000s, an era that was globally known for its economic downturn, famously referred to as the Great Recession. Countries across the world were navigating through turbulent financial waters. Among them was the European Union, a robust alliance of European countries that had economically interwoven their destinies. The European Union, being a veritable patchwork of shared economic interests and mutual dependencies, was not untouched by this global financial storm. Its susceptibility to the global recession was not merely a consequence of its economic integration, but resulted from a combination of internal and external factors. Many economies worldwide were grappling with the economic downturn, but the crisis significantly impacted the European region. It unveiled underlying structural fragilities within the economies of several of its member states, particularly Spain and Italy. These nations, once seen as the pillars of European prosperity, were now teetering on the brink financial abyss. Spain and Italy were grappling with an economic double whammy: high public debt compounded by growing fiscal deficits. The financial crisis, which was initially sparked a housing bubble in the United States, had now spread to Europe, affecting these countries significantly. The impact was multiplied due to their economies' structural weaknesses, which were rooted in years of fiscal mismanagement and hampered by political instability. These nations, laden with public debt that was reaching alarming proportions, were also dealing with fiscal deficits that were spiraling out of control. The recession, which was already causing economic distress globally, exacerbated these conditions, pushing countries towards a full-blown financial crisis. The nations were not merely dealing with an economic downturn, but were struggling in a vortex of increasing debt and declining growth. The crisis revealed structural weaknesses in the economies of several member countries, including and Italy. These nations were struggling with high levels of public debt and fiscal deficits, which were exacerbated by the recession. In Spain, a housing bubble had burst, leading to massive job losses in the construction sector and a banking crisis. The bubble, which had been formed over several years due to unrestrained lending practices, suddenly popped, leaving a trail of financial ruin in its wake. Thousands of unfinished homes dotted the landscape, while many of the nation's banks, burdened with bad loans, were on the brink of collapse. This financial fiasco had sent shockwaves throughout the country, affecting every individual from the rich to the poor, from the urban dwellers to the rural populace. Mirroring the dismal fate of countless homes was the massive unemployment rate in the sector, spiraling to unprecedented levels. Many construction companies, both large and small, shuttered their operations, leaving many households without an income source. The job market was saturated with unemployed construction workers, leading to a steep drop in consumer spending, further fueling the economic downfall. Meanwhile, Italy was grappling with its own set of problems. For years, the country had been wrestling with stagnant economic growth and a high public debt to GDP ratio. Its economy was static, showing no signs of improvement, while its public debt was mounting. Italy's high public debt to GDP ratio was a result of years of fiscal irresponsibility, with the government spending beyond its means and failing to implement the necessary reforms to stimulate economic growth. As a result, Italy was on the edge of a fiscal cliff, and like Spain, was also feeling the repercussions of the global economic downturn. Adding to the misery, the global recession that had been wreaking havoc worldwide further exacerbated these issues. This perfect storm of local and global financial challenges pushed both countries into a severe financial crisis. Coupled with the global downturn, these issues pushed both countries into a severe financial crisis. During the crisis, the impact on citizens was profound. Like an unannounced storm, it arrived, ripping through the fabric of society, shaking the very essence of everyday life. The crisis was not only a macroeconomic phenomenon, but an intruder into the homes of ordinary people, casting a shadow of uncertainty and fear. Unemployment, that dreaded specter of economic failure, soared like a malevolent bird of prey. It reached its talons, especially into the lives of young people, the promising youth of our nation. All around, the bright, ambitious dreams of individuals ready to take on the world were suddenly and cruelly snuffed out. It wasn't just an increase in statistics, it was a suffocating grip on the future of an entire generation. The financial hardship was severe, as if the crisis was a cruel winter that refused to end. Money, that essential commodity for survival, became scarce. Many, once comfortable and secure, found themselves teetering on the edge of a precipice, staring down into an abyss of poverty. And austerity measures were implemented, a desperate attempt to control the spiraling situation. The government's belt tightened, the squeeze felt in every home. Cuts to public services, once considered essential, now became the norm. Libraries, healthcare, education, services that once symbolized a caring society now became the casualties of an economic war. Wage freezes were felt like an icy slap in the face. Many hardworking individuals already battling to stay afloat found their income stagnated in the face of rising costs. Workers once proud and secure now found themselves locked in a battle for survival. Despite the chill of the crisis, the resilience of the human spirit shone through. People clung to hope, finding strength in unity and resources in innovation. They adapted, they survived, and in surviving they began to heal. When the financial crisis hit, regulators found themselves in a precarious position. The situation was grave, with economies stumbling and teetering on the edge of collapse. The European banking system was in chaos, and the ripple effect of the crisis had reached far beyond the European borders to the global economy at large. Caught between a rock and a hard place, the regulating bodies had to take swift and decisive action. The European Central Bank, ECB, and the International Monetary Fund, IMF, came forward, acting as the knights in shining armor. They intervened with significant bailout packages intended to resuscitate the struggling economies and steady the rocking ship of the European markets. However, these bailout packages came with strings attached. They were tied with strict conditions that necessitated the reduction of fiscal deficits. The regulators knew that they had to implement harsh measures to combat the crisis, which was in full swing and showed no signs of slowing down. This called for the implementation of austerity measures, which were deeply unpopular among the public. The conditions included cutbacks on government spending, increase in tax revenues, and structural reforms. Such measures were seen as necessary to balance the budget and reduce the burgeoning public debt. However, their impact was far-reaching, affecting everyday life of the citizens, and stirring up a strong public backlash. The economic reforms that introduced also had a profound effect on the economy. These reforms aimed at making the economy more competitive and agile to withstand future shocks. They included changes in labor laws, pension reforms, and measures to boost productivity and competitiveness. However, they too were met with resistance, as they were seen as undermining workers' rights and social protection. The crisis didn't just have economic implications, but also affected the political landscape in both countries. The public reaction to the crisis and the measures taken to combat it resulted in significant political shifts. In Spain, the economic turmoil led to the rise of new political parties, disrupting the traditional two-party system that had been in place for decades. In Italy, the crisis had a different impact. The economic hardship and the perceived failure of the traditional political elite to effectively tackle the crisis led to a surge in populist sentiments. Citizens started questioning the existing political structures and the politicians who represented them. They felt increasingly disillusioned with the traditional political elite. This sense of disillusionment and discontent was not just limited to Italy, but was a sentiment echoed across Europe. So, while the crisis was ultimately a financial one, its impact was far-reaching, affecting all areas of life and significantly reshaping the political landscape in Europe. The crisis showed that no economy is an island, and that economic decisions can have profound social and political implications. It underscored the need for prudent fiscal management and the importance of robust economic structures. The financial crisis was undoubtedly a wake-up call for the European Union. It was an event of such magnitude that it sent shockwaves throughout the region, acting as a catalyst for the restructuring of fiscal policies and measures. The tumultuous period of the crisis led to a significant shift in the Union's approach to financial management. In response to the crisis, there was a strong push for greater fiscal integration. This seen as a necessary step in fortifying the Union's financial stability against potential future crises. The goal was essentially to create a more unified approach to monetary policy and fiscal responsibility, promoting stronger ties between member nations and encouraging collective responsibility in managing the region's finances. The establishment of the European Stability Mechanism was a direct outcome of this push. This permanent bailout fund was designed as a safety net, a financial buffer that would ensure the Union's ability to weather any future economic storms. It signaled a commitment to a more integrated, collective approach to fiscal management within the Union, underlining the belief in shared financial risks and rewards. However, the crisis also opened up Pandora's box of issues within the Union. It exposed the underlying vulnerabilities of the Union's financial structure, revealing in the foundation that had been overlooked or ignored in the past. The fallout from the crisis highlighted the inherent risks and drawbacks of such a unified financial system, leading to a surge of criticism and doubt regarding the Union's fiscal policies. This exposure contributed to a growing wave of Euroscepticism across the region. The crisis fueled doubts about the viability and effectiveness of the Union's financial structure, leading to increased questioning of its methods and policies. In the aftermath of the crisis, more and more citizens began to question the Union's ability to effectively manage the region's finances. The financial crisis was a wake-up call for the European Union. However, the crisis also exposed the Union's vulnerabilities and contributed to growing Euroscepticism across the region. Fast forward to 2023, the state of finance in the European Union has dramatically shifted gears, voyaging into a territory of newfound stability and robustness. The bloc, once caught in the throes of an unrelenting crisis, has tirelessly labored to transform the landscape of its economic and financial domain. We have seen the European Union engage in a multi-dimensional effort to fortify its financial architecture, making it more resilient, agile, and robust than ever before. It's as if a phoenix has risen from the ashes of the economic turmoil that had threatened to consume the continent. Central to this reinvigoration story are Spain and Italy, two countries that have displayed exceptional resilience in the face of enormous adversity. These nations have adhered to a slow and steady path of recovery, a testament to their gritty determination and dogged perseverance. They've worked diligently, bolstered by the collective strength of the European Union, to nurse their economies back to health. Their journey has been an intensely arduous one, marked by countless challenges and unforeseen hurdles. Yet they've held firm, setting an example for other nations grappling with similar economic woes. However, even in the face of this encouraging progress, the shadow of the devastating crisis continues to loom large, casting a sullen pall over the European Union. This omnipresent specter has indelibly shaped economic policies, pushing for more prudent fiscal management and tougher financial regulation. It has also left a lasting imprint on public sentiment, instilling a deep-seated wariness towards reckless financial practices. And now comes the million-dollar question: did the EU crisis contribute to the UK's decision to exit the bloc via Brexit? The answer is an intricate labyrinth of complexity. While the economic catastrophe undeniably revealed the inherent challenges of economic integration and amplified Euroscepticism, Brexit wasn't solely a reaction to these elements. Instead, it was shaped by a plethora of diverse factors, each tangled in a web of interconnected political, economic, and social dynamics unique to the UK. Brexit was a monumental decision, a product of a complex mixture of elements that are intertwined inextricably with the UK's identity and destiny. While the crisis revealed the challenges of economic integration and fueled Euroscepticism, Brexit was influenced by a multitude of factors, including political, economic, and social dynamics unique to the UK. This journey through the European Union's financial crisis offers valuable lessons in economic resilience, policy-making, and the intricacies of regional integration. It's a story of triumph over adversity, of unity in the face of divisive forces, and it's a narrative that carries with it the weight of history and the hope for a brighter future. It's a tale that proves that, together, we can overcome anything. The European Union's financial crisis was a test of fortitude, a litmus paper for the solidarity of this unique economic and political alliance. In the face of looming recession, the European Union has shown remarkable resilience. It's managed to reform its policy-making mechanisms, tighten its financial regulatory structures, enhance financial stability, and strengthen its institutional setup. The crisis served a wake-up call, pushing the Union towards a more robust, more resilient, and more integrated future. However, the journey wasn't a smooth sailing one. It was marked by significant hurdles, policy disagreements, and economic downturns. But the true strength of the European Union lay in its ability to adapt, to evolve, to learn from its failures, and to emerge stronger from the ashes of despair. It was in this struggle, this journey, that the true character of the European Union was revealed. And this is just a glimpse into the fascinating world of the European Union's financial crisis, a world that's full of lessons for economic resilience, policy-making, regional integration, and so much more. So, if you found this exploration engaging and enlightening, then there's where that came from. Do hit the like button, share this video, and don't forget to subscribe to our channel for more insightful content. There's a world of knowledge waiting for you out there. Until next time, keep those curious minds ticking.